before anything else. The same date stamp this channel attaches to every video discussing a specific, named security, because it matters here more than almost anywhere else on this channel. Every number in this video, unit price, distribution yield, payout ratio, occupancy, funds from operations, is sourced from SmartCentres' own quarterly results releases and public financial data providers, dated specifically across late 2025 through mid-2026. By the time you watch this, several of these figures will have moved. That is simply the nature of discussing one specific company rather than a diversified ETF, and exactly why every figure in this video comes with its source and date attached. With that said, here is a genuine, well-documented contradiction worth understanding before anyone treats this REIT as a simple, obvious income pick. SmartCentres REIT, trading on the TSX under the ticker SRU.UN, reported industry-leading occupancy of 98.6% at the end of 2025, same property net operating income growing 3.7% over the year, and a CEO publicly describing strong financial and operational performance. At the same time, this is a REIT whose monthly distribution to unit holders has shown essentially no growth over either the trailing 3-year or trailing 5-year period, according to one Dividend tracking data source, and whose own most recent quarterly results showed funds from operations per unit actually declining year over year, even as the underlying property portfolio's net operating income grew. A growing business, a frozen or even slightly shrinking per-unit payout. This video explains exactly why both of those things can be true simultaneously, what SmartCentres actually owns, the specific number buried in its own results that explains the gap, and what this means practically for a Canadian investor specifically using it for dividend income. Before evaluating the income side of this REIT, it is worth understanding precisely what SmartCentres actually owns, because the portfolio's specific composition, heavily concentrated around a single anchor tenant, is directly relevant to the risk side of this video covered later. The core retail portfolio, SmartCentres, is one of Canada's largest fully integrated REITs, reporting approximately $12.1 to $12.3 billion in total assets across roughly 195 to 200 properties, comprising approximately 35.3 to 35.6 million square feet of income-producing space on 3,500 acres of owned land across Canada, with 97.3% to 98.6% in place and committed occupancy depending on the specific reporting date. Occupancy levels the company itself, and independent commentary covering it, both describe as industry-leading for a retail-focused REIT. The Walmart concentration, the single most important structural fact about this portfolio. Walmart anchors the large majority of SmartCentres retail properties, one source citing 114 to 176 Walmart-anchored centers specifically, with Walmart alone representing approximately 23.2% to 25% of the REIT's annualized gross rental revenue. This is not incidental. Walmart's traffic-generating power is explicitly part of the company's own investment thesis, with the company's own commentary noting that customers visiting Walmart also patronize the smaller surrounding tenants, coffee shops, clinics, restaurants, services, in the same plaza, helping sustain rent payments across the broader property. Beyond traditional retail, the densification strategy, and Project 512. SmartCentres has been pursuing a long-term densification strategy, converting underused parking lots and low-intensity retail sites into mixed-use developments incorporating purpose-built rental apartments, condominiums, seniors housing, self-storage, and office space, branded under SmartLiving for the residential component. The company has publicly announced a $14.9 billion transformation plan, referred to internally as Project 512, developing holistic master plans across its portfolio. As of the company's most recent disclosures, SmartCentres operates 14 self-storage facilities with several more under construction, and is advancing residential projects including Vaughan area townhomes, with 118 of 120 Phase 1 units closed as of the end of 2025. Why this dual structure matters for an income investor specifically. SmartCentres is not simply a static collection of Walmart-anchored strip malls collecting rent. It is a REIT explicitly pursuing additional growth through land development on real estate it already owns, layered on top of its existing retail income stream. This creates two distinct components to evaluate: the stability and predictability of the existing, occupied retail income, covered in Segment 2, and the separate, genuinely uncertain execution risk and timeline tied to converting development pipeline into actual income-producing completed projects, covered in Segment 4. Your action step. Before evaluating SmartCentres purely as a current income yield, explicitly separate in your own mind the existing occupied retail portfolio component of the business from the in-progress densification and development pipeline component. Because, as covered later in this video, the company's current distribution is supported primarily by the first component, while much of the company's own public growth narrative is tied to the second. Here is the vault from the opening. The specific number, sourced directly from SmartCentres' own results, that resolves the apparent contradiction between a growing business and a frozen distribution. The current distribution picture, sourced across late 2025 through mid-2026, SmartCentres pays a monthly distribution, with one source citing CAD 0.154 per unit per month as of early 2025 results, and a unit price reported at approximately 25 Canadian dollars and 50 cents as of mid-May 2026, implying a distribution yield in the broad vicinity that multiple dividend tracking sources place at approximately 6.16% to 6.97% across various dates in this research window, depending on the exact unit price and trailing distribution figure used. This is a meaningfully higher yield than any of the bank, utility, or rail stocks covered in this channel's other Canadian dividend stock videos, consistent with the generally higher yields typical of the REIT structure, covered in this channel's dedicated REIT video, given the legal requirement for REITs to distribute the large majority of their taxable income. The payout ratio, two measures, two different pictures. SmartCentres' payout ratio is reported differently depending on which specific cash flow measure is used. On a funds from operations basis, one source cites a payout ratio around 64.7%, a comfortable, sustainable-looking figure. On a more conservative cash flow basis, the same source cites a payout ratio closer to 84.9%, a meaningfully tighter cushion, and a useful, real example of exactly the kind of measurement method sensitivity covered in this channel's other REIT-focused content, where the specific cash flow metric chosen can materially change how safe a payout ratio appears. Here is the specific number that resolves the contradiction. FFO per unit declined year over year, even as total NOI grew. SmartCentres' own first quarter 2026 results reported funds from operations, FFO, of 54 cents per unit, down from 56 cents a year earlier, and FFO with adjustments of 52 cents per unit, down from 54 cents, explicitly attributed by the company's own disclosure to higher interest costs and general expenses, only partly offset by the underlying net operating income growth of 0.7% to 3.7%, covered in Segment 1. This is the precise mechanism behind the contradiction from the opening. The underlying property portfolio is genuinely generating more operating income, but a combination of higher borrowing costs and general expense growth is consuming that improvement before it reaches unit holders on a per-unit basis, leaving little room for the distribution itself to grow, and explaining the flat 3-year and 5-year distribution growth trend flagged in one dividend tracking source. Why this matters more than the headline operational language. REIT's press release will, understandably, emphasize the genuinely positive figures. Occupancy, same property NOI growth, leasing momentum, because those figures are real and accurately reported. But for an income-focused investor specifically, the FFO per unit trend is the more directly relevant number, because it is FFO and AFFO, not total NOI, that ultimately funds the distribution actually paid to each individual unit holder. And on that specific, unit holder relevant measure, the trend in this most recent quarter was a decline, not the growth that the occupancy and NOI headlines alone might suggest to a less careful reader. Your action step. For any REIT, you are evaluating for income specifically, not just SmartCentres. Locate the FFO per unit and AFFO per unit figures directly in the company's own quarterly results, rather than relying on headline NOI or occupancy figures alone, since FFO and AFFO per unit are the specific measures most directly tied to the sustainability of the actual distribution you receive. Having covered the current income picture honestly in Segment 2, it is worth covering the other half of the story just as honestly. The genuine, sourced reason some analysts and commentators view SmartCentres as more than just a static retail income vehicle. The bull case, as described by independent coverage, one recent analysis frames SmartCentres' payout and valuation as appealing for income-focused investors specifically, while explicitly noting investors need a balanced view. Separate independent commentary specifically flags the densification strategy as the big wild card, explaining, if SmartCentres can successfully transform parking-heavy retail sites into full mixed-use communities over the next decade, there's meaningful upside baked into land that the market may not fully price in right now. This is a genuine, real argument. SmartCentres owns 3,500 acres of land outright, much of it currently used only for surface parking around existing retail buildings, and converting even a portion of that land into income-producing residential, office, or self-storage development represents a real, additional source of future value beyond simply collecting rent on existing retail leases. Recent leasing momentum specifically supports near-term confidence in the existing portfolio. SmartCentres' first quarter 2026 results showed lease extensions producing average rent growth of 11.5%, excluding anchor tenants, with approximately 80% of leases maturing in 2026 already extended, at rent growth of 5.8%, including anchors. Genuinely strong figures suggesting the existing retail portfolio retains real pricing power with its non-anchor tenants specifically, separate from the densification story. The honest, explicit execution risk, stated directly by the same sources providing the bull case. The same independent analysis that frames the densification story positively is equally direct about the risk. If those projects stumble, the trust still has its core retail engine, but less juice on the growth side. The same source's own risk section states plainly, debt costs can pressure FFO, consumers may slow spending, construction can run late or over budget, and leverage also deserves attention. This is not a hidden or obscure risk. It is stated explicitly, in plain language, by the exact same coverage that is otherwise constructive on the stock. Why the next decade matters as a specific phrase, not just a turn of phrase. The independent commentary specifically frames the densification upside as something that plays out over the next decade, language that should recalibrate any income investor's expectations about timeline. This is not a near-term catalyst likely to meaningfully change the FFO per unit trend, covered in Segment 2 within the next year or two. It is a long-horizon transformation plan whose ultimate payoff, by the most favorable available framing, is explicitly years away and contingent on successful execution of large, complex, multi-year construction and approval processes across dozens of individual sites. The honest synthesis: SmartCentres in mid-2026 is, by the sourced evidence in this video, simultaneously a REIT with a genuinely strong high occupancy, pricing power retaining core retail business, a current distribution that has not grown meaningfully in 3 to 5 years and is currently being pressured by rising interest costs at the FFO per unit level, and a long-horizon, multi-billion-dollar densification opportunity that independent commentary explicitly frames as the big wild card, genuinely promising, genuinely uncertain, and explicitly playing out over a decade-long timeline rather than the next few quarters. Your action step: if you are specifically attracted to SmartCentres because of its densification and Project 512 narrative explicitly separate in your own evaluation the value you are assigning to land and development potential that has not yet been monetized from the value of the existing income-producing retail portfolio that currently funds the actual monthly distribution you would receive. These are two different things, on two very different timelines, and conflating them risks overestimating how directly the development story translates into near-term distribution growth. Here is how SmartCentres' specific distribution fits into the broader REIT taxation framework already covered in detail in this channel's dedicated REIT video, applied specifically to this one company. The composition of the distribution, building directly on this channel's REIT video, as covered in this channel's dedicated REIT explainer. REIT distributions are frequently composed of multiple distinct tax components: a portion treated as regular income, a portion that may be treated as a return of capital, which reduces your adjusted cost base rather than being immediately taxed, and in some cases a portion eligible for capital gains treatment, with the specific breakdown disclosed annually on the T3 tax slip rather than being a single, fixed percentage. SmartCentres, like other Canadian REITs, will issue a T3 specifying exactly how much of your received distribution falls into each category for that specific tax year, and this composition can and does vary from year to year. The TFSA consideration: the most straightforward approach for most Canadian investors. Holding SmartCentres units inside a TFSA shelters the entire distribution from tax, regardless of its specific T3 composition in any given year, exactly as covered in this channel's REIT video, meaning a Canadian investor specifically prioritizing simplicity and full tax-free treatment of the relatively high approximately 6% plus yield covered in Segment 2 does not need to track or understand the T3 breakdown at all if SmartCentres is held inside a TFSA specifically. The non-registered consideration: for an investor holding SmartCentres in a non-registered account, the return of capital portion of the distribution specifically, common for REITs given their typically large depreciation and amortization charges, similar to the dynamic covered for Enbridge in this channel's other dividend stock video, defers tax rather than eliminating it by reducing the adjusted cost base of the units. This means a portion of what looks like a high current yield is, in effect, a partial return of the investor's own original capital rather than purely investment income, a nuance that becomes relevant specifically when the units are eventually sold, since a lower adjusted cost base produces a larger capital gain at that point. Connecting back to the diversification principle from this channel's other content, as covered in this channel's dedicated REIT video, a single REIT like SmartCentres, however large, well-occupied, and well-known, represents concentrated exposure to one specific company's specific properties, specific tenant mix, and specific management execution, distinct from the diversification achieved by holding a broad REIT ETF, such as VRE, which spreads this same underlying real estate income exposure across dozens of different Canadian REITs and multiple property sectors simultaneously. SmartCentres' heavy Walmart anchor concentration, covered in Segment 1, is precisely the kind of single-company, single-tenant relationship risk that a diversified REIT ETF specifically reduces. Even while a name like SmartCentres may offer income-focused investors a more direct, identifiable, easier-to-research story than a diversified basket would. Your action step: if you are specifically interested in real estate income exposure and are deciding between a single REIT, like SmartCentres, and a diversified REIT ETF, like VRE, explicitly weigh the trade-off covered throughout this video and this channel's other REIT content. A single, well-understood, currently higher-yielding name with concentrated tenant and execution risk, versus broader diversification with a typically lower individual name yield contribution but reduced single-company risk. Let's come back to where we started. A REIT with industry-leading occupancy, growing same-property NOI, and a CEO publicly describing strong performance, alongside a monthly distribution that has shown essentially no growth over the trailing 3 and 5 years, and a most recent quarter where FFO per unit actually declined. You now understand exactly why both of those things are simultaneously true. SmartCentres' existing Walmart-anchored retail portfolio is genuinely performing well at the operating level. High occupancy, real rent growth on lease renewals, strong leasing momentum. But rising interest costs and general expense growth have, in the company's own most recent disclosed quarter, consumed that operational improvement before it reached unit holders on a per-unit basis, which is precisely why the distribution itself has been frozen, even as the underlying business has grown. Layered on top of this current income picture is a genuinely separate, longer horizon story. A $14.9 billion densification plan converting underused land into future income streams, explicitly described by independent coverage as the big wild card, real, sourced upside potential, paired with equally real, equally sourced execution risk, playing out over a decade rather than the next few quarters. A approximately 6% plus current yield. A tight but not alarming payout ratio depending on which cash flow measure you use. A flat recent distribution growth trend. And a long-term development story that may or may not materially change that trend within any specific investor's own holding period. That is the complete, honest picture, not a verdict, but the full set of sourced facts a careful income-focused Canadian investor needs before deciding how this specific name, if at all, fits into a broader portfolio alongside the diversified options covered elsewhere on this channel.